Hello everyone, my name is Annisa Nurul Fitri with NPM 2441207 from Accounting Class 24A. Today, I will present material about working capital management. This topic is important because working capital is the financial foundation that keeps a company's daily operation running smoothly. So, let's start by understanding what working capital really means. So, working capital refers to all current assets used in a company's day-to-day operation, such as buying raw materials, paying salaries, and settling short-term debts. In simple terms, working capital equals current asset minus current liabilities. If the result is positive, it means the companies can easily meet its short-term obligation. The main purpose of working capital is to ensure the company never runs out of cash for daily activities. Next, let's discuss working capital policies, which determine how much current asset a company should hold and how to finance them. There are their main policies. First, the conservative policy, where the company keeps a large amount of current assets. This is safe but less profitable. Second, the aggressive policy, which minimizing current asset and use more short-term debt. This has higher risk but also higher potential return. And third, the moderate policy, which balance both approaches to manage risks and profit effectively. Source of working capital. Working capital can come from two main sources, internal and external. Internal sources include retained earnings, depreciation, and the sale of unused fixed assets. External sources include short-term loans, issues, new shares, or selling bonds. A good company combines both internal and external funding sources to maintain stability and flexibility. Concept of working capital and cash flow. Working capital is closely linked to cash flow because it reflects how well a company manages its operation funds. There are two main concepts. First, gross working capital, which means total current asset, and net working capital, which is current asset minus current liabilities. When cash comes in, for example, from sales, working capital increases. When cash goes out, for instance, for purchasing or debt payments, working capital decision. Cash flow and motives for holding cash. Cash is essential for maintaining liquidity. Companies hold cash for three main reasons. First, the transaction motive, to meet daily payments such as salaries and bills. Second, the precautionary motive, to prepare for emergency or unexpected needs. And third, the speculative motive, to take advantage for profitable business opportunities like sudden discuss or investment. Cash management. Cash management is one of the most essential aspects of working capital management. It focuses on maintaining the right balance between having enough cash to operate and avoiding excessive idle funds. The main objective of cash management are to ensure that the company always has enough cash to meet an obligation, to minimize idle cash to don'ts general return, and to make use of any excess cash through short-term investment. There are four key steps in managing cash effectively. The first is cash planning, where the company estimates future cash needs to anticipate possible shortages or surplus. The second is cash control, and the third is temporary cash investment, where excess funds are placed in short-term financial instruments such as deposit or treasury bill to earn additional income. And finally, cash monitoring, which ensures that available cash remains sufficient for operational needs all the time. To conclude, managing working capital effectively helps a company maintain liquidity, solvency, and profitability. Without proper management, even profitable companies can face financial trouble due to poor cash flow. Therefore, every business must pay attention how it manages its working capital because it directly affects the company success and sustainable. Thank you for listening.